Welcome back to the deep dive. It's December 17th, 2025, and if you're just looking at the Bitcoin price chart right now, well, you're seeing a lot of red and probably feeling a little
To
anxious.
say the least.
Bitcoin is trading very defensively, kind of clinging to that mid $86,000 level, and it seems to be reacting to every little macro tremor out there. You've got the looming threat from the Bank of Japan, you have the usual year-end tax harvesting pressure, and maybe most importantly, these pretty significant institutional ETF outflows.
It looks nervous. It looks bearish.
It feels like capitulation to a lot of people.
It does. And that is the immediate price reality. We can't ignore it. But, and this is really the whole point of this deep dive, that short-term fear is completely masking a structural, almost generational revolution happening just beneath the surface.
A revolution.
We are witnessing the most extreme divergence I've ever seen between price and fundamental progress.
So what does that mean exactly?
It means the global financial architecture isn't just, flirting with digital assets anymore. It's being aggressively rewired for them. You have nation-states accumulating Bitcoin like a treasury reserve.
Right.
And at the exact same time, global payment processors are integrating these rails into the very core of the banking system we already use.
Okay, so let's unpack this. Our mission today is to cut through that noise. We've synthesized all the net new intelligence, sovereign adoption, infrastructure, regulation, and of course, the harsh realities of the current market.
We need to explain why the price is selling off while the real progress just keeps accelerating.
Let's start with what you called the revolutionary stuff. The shift away from just speculation to Bitcoin as a productive national instrument, and we have to start with the Kingdom of Bhutan.
This is a textbook paradigm shift.
Yeah.
Bhutan isn't just passively holding Bitcoin like digital gold. They're actively mobilizing it.
Mobilizing it how?
They've confirmed they're deploying a huge tranche of their national holdings. We're talking 10,000 BTC, which is about $1 billion, to finance their massive Gelephu Mindfulness City project.
$1 billion. That's a huge move. But how is this different from, say, what El Salvador did? This feels much more strategic.
It is. The critical difference is where their Bitcoin comes from. It's almost entirely from state-backed mining operations.
Which are powered by their surplus hydroelectric energy.
Exactly.
Yeah.
So their cost basis for this asset is incredibly low, way, way below the current spot price.
So they're taking something that would otherwise be wasted or exported cheaply, that surplus energy, and they're converting it directly into a high-value liquid asset.
Precisely. And by doing that, they completely sidestep the traditional financing route. No massive external debt from the IMF or the World Bank.
They're preserving their fiscal autonomy.
They are printing their own productive capital without owing anyone for it.
But let me just push back on that for a second. Is there a risk here? By cashing in 10,000 BTC now, aren't they basically converting a long-term resource, their future energy surplus, into short-term capital?
That's a fair strategic question. It's not a perfect model, but the immediate power of it is undeniable. They're creating a blueprint for other resource-rich nations. They're treating Bitcoin as sovereign collateral to attract foreign direct investment.
So it de-risks the project for outside investors.
It makes Bitcoin foundational to urban planning and national leverage. It's just a whole new level.
And then, for a complete contrast, you have Russia's Sberbank.
This really shows the dual nature of these assets. Sberbank, Russia's largest state-owned bank, is cut off from Western finance because of sanctions. So what are they doing?
They're pivoting.
They're pivoting hard. They're actively testing DeFi products and asset tokenization on the Ethereum public blockchain.
A state-owned banking giant using a permissionless public chain. That's astounding.
They're leveraging its censorship resistance to bypass things like SWIFT. They're not building some private walled garden ledger. They're going straight to Ethereum because it's robust, decentralized, and therefore sanction-proof.
So these open protocols serve everyone.
Even state actors facing isolation. It's a pragmatic financial lifeline.
It's incredible to see these completely different strategic uses, but none of that matters if the tech plumbing isn't ready. And it feels like we're way past the pilot phase for commercial use now.
We are. The biggest news here, without a doubt, is Visa's watershed announcement.
Tell us about it.
Visa has officially launched USDC stablecoin settlement in the United States. This is not a test, it's live. And they're using the Solana blockchain to do it.
The big question is why Solana? Why not Ethereum?
It came down to a purely technical need: speed, settlement velocity. VisaNet needs to process thousands of transactions per second with, near instant finality.
So the high-performance layer 1 thesis just got a massive validation.
It did. For this specific use case pure settlement speed, Solana was just the superior choice over Ethereum's main app.
And the relevance for banking is huge. This is a fundamental upgrade to the plumbing of the fiat system.
It enables true 24/7 liquidity management for banks. Think about it. Billions of dollars get trapped over weekends and holidays because systems like SWIFT and ACH are closed.
This bypasses that entirely.
Completely. It frees up all that trapped capital. It's an efficiency gain worth billions a year.
And while the banks get faster, the user experience is getting simpler. MetaMask just made a huge move.
A giant leap, really. Consensus, their parent company, launched native Bitcoin support in MetaMask.
For the user, what does that actually mean?
It means an end to all that wallet fragmentation. You don't need separate apps for the Bitcoin and Ethereum ecosystems anymore. And crucially, you don't need to rely on those complex, kind of risky wrapped tokens like WBTC.
It just simplifies everything.
Dramatically. A much easier entry point for institutions and individuals.
At the same time, corporate treasuries are signaling they're looking beyond just Bitcoin. Bitmine Immersion Technologies made a really bold move.
They did. They've accumulated over 3.8 million ETH, and they're openly targeting 5% of the total supply.
And their reasoning is fascinating.
It really is. They see ETH as the necessary gas for the future of Wall Street, for the mass tokenization of traditional assets. And because ETH offers a native yield through staking, it's a cash flow generating asset in a way that Bitcoin isn't.
So they're positioning themselves to profit from the network's actual utility.
Not just its price appreciation. It's a much more mature strategy.
And just to round out the infrastructure picture, over in Asia, HashKey Group completed a big IPO in Hong Kong.
A $205 million IPO. This is important because it creates a regulated stock for investors who want exposure to the Asian crypto market without directly holding the assets. It really solidifies Hong Kong's role as a compliant institutional hub.
Okay, that is all undeniably bullish. But adoption is never a straight line. Let's pivot to the friction, the obstacles, and it starts with a big geopolitical break.
Yeah, the U.S. suspended the big tech prosperity deal with the U.K. This was supposed to align two of the world's biggest economies on emerging tech, including digital assets.
And now that's on hold. What's the consequence?
It threatens to bifurcate the entire regulatory landscape. It could be a compliance nightmare for firms that need to operate in both London and New York.
And maybe even worse.
Worse is that it could delay alignment on critical things like post-quantum cryptography. That's a long-term existential risk for the security of all blockchains if the West isn't working together.
And then there's the legal landscape right here in the U.S. The lawsuit against Pump Fund just got a lot scarier.
This might be the most crucial legal development of the year. The lawsuit was amended to include HICO charges.
ISAR. That's the Racketeer Influenced and Corrupt Organizations Act. That's the law they used to go after the mob.
Exactly. And they're not just naming the token creators. They've named infrastructure providers like Solana Labs and Geno Labs as co-defendants.
What's the argument there?
They're arguing that these labs aren't neutral tech providers, but are active participants who profit from the alleged pump enterprise through transaction fees.
And if a court accepts that?
If that happens, it completely shatters the neutral infrastructure defense. It would mean protocol developers could be held liable for what third parties do on their open networks.
Which would force them to censor transactions?
Censor transactions, implement KYC at the protocol level. It would effectively end permissionless innovation in the U.S. and push all future development offshore. It's an existential threat.
And all this is happening while actual regulation remains completely stalled.
It is. The Senate Banking Committee just officially postponed the market structure bill until 2026. At least 6 more months of limbo, which institutions hate.
Meanwhile, the UK is moving ahead.
The UK Treasury is drafting comprehensive legislation. They're providing clarity, which is a huge competitive advantage.
We should also mention that coin laundry report from the ICIJ.
Right, exposing how crypto ATMs are being used for fraud. A 99% increase in complaints. You have to expect a swift regulatory crackdown on those physical access points.
Okay, so let's bring all this back to the price, to that fear we started with. The primary macro risk is coming from the Bank of Japan.
Absolutely. The markets are pricing in a 94 to 98% probability of a rate hike on December 19th. That is the main event this week.
For listeners who don't follow central banks that closely, break this down. Why does a Japanese rate hike matter so much for Bitcoin?
It's all about the yen carry trade. For years, you can borrow Japanese yen for basically zero interest, convert it to dollars, and invest in higher-yielding assets like stocks or crypto. It's been a massive source of cheap global liquidity.
So if the BOJ raises rates,
That whole trade unwinds. It becomes more expensive to borrow yen, so traders are forced to sell their risk assets like Bitcoin to pay back their loans. It sucks liquidity out of the global system fast.
which explains the fear. And the technical chart reflects that. Bitcoin is in this tight defensive range.
Very tight, between about $85,100 and $88,000. And the indicators are not good. The price is well below the 50-day moving average, which is now resistance at around $95,000.
And the RSI.
The RSI is stuck around 44. That's classic no man's land. It just confirms that sellers are in control and buyers don't have any conviction.
You've identified a capitulation target of $74,000. What does that mean exactly?
It's where the technicals suggest we'll find the next major area of support if that critical $85,000 floor breaks. If we lose 85K, it signals a real loss of confidence, and algorithms and traders will immediately look to $74,000 as the next logical place for big buyers to step in. It's the point of maximum pain.
And we know what fueled this immediate sell-off. The ETF flows tell a clear story.
A very clear story. Over $630 million in outflows from the Spot ETFs in just 2 days. And the most alarming number was a $210 million outflow from BlackRock's IBIT. That is institutional de-risking ahead of year-end. Plain and simple.
But, and this is a key nuance, the capital isn't leaving the asset class entirely. It seems to be rotating.
This is the most sophisticated signal we're getting. While Bitcoin ETFs are bleeding, Spot XRP ETFs just crossed $1 billion in inflows. Solana ETFs are also holding up well.
So capital is moving to assets that are perceived to have better regulatory clarity or a specific proven use case.
Exactly. It's not a flight from crypto. It is a rotation into utility.
And then you have the big counter-narrative from Bitwise arguing that the classic 4-year halving cycle is dead.
Their report argues that the scale of institutional adoption, the ETF flows, sovereign buying, that this has all superseded the halving supply shock as the main price driver. They're predicting new all-time highs in 2026 based on this secular growth.
That's a fundamental challenge to how most people think about Bitcoin.
It forces everyone to reevaluate their models.
Which brings us right back to where we started, the dislocation. In the short term, you have to hedge against the liquidity shock from the BOJ. That $74,000 target is real.
It is. But at the same time, you have to recognize that the medium-term structural bid is now geopolitical and commercial. The floor for the next cycle is being built by Visa and sovereign treasuries, not just retail hype.
So the divergence between price, which is bearish, and progress, which is bullish and foundational, is as wide as it's ever been.
The progress is cemented. Visa is settling on Solana. Bhutan is funding a city. That's real. Whether Bitcoin is at $86,000 or $74,000 next week, the infrastructure is here to stay.
So here's the provocative thought for you to chew on after this deep dive. If Bitwise is right, if the scale of institutional adoption has truly killed the 4-year halving cycle, what metrics should you be tracking instead? What really drives price when institutional scale takes over? Is it ETF flows, geopolitical adoption, something else entirely? Think about that as we head into 2026.